The Dow Jones Industrial Average is down 10% and the S&P 500 is down 14% year to date. Every day on television, we hear how stocks are performing and hear from experts on what stocks will do in the future. These headlines dominate our everyday lives, and yet most people have an imperfect understanding of how financial markets function. You don't need to be a master of financial markets to be able to invest successfully. However, you need to have a good understanding of the basics. And there are two positions which, when taken in your investment account, can potentially prove to be very, very risky. I am going to talk about those positions when I cover some basics. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. And I have helped dozens of men and women take control of their financial futures. Subscribe to my YouTube channel and follow my Facebook page to learn how you can build your own wealth through investing. This video is the second one in my series of videos on the basics of stock market investing for beginners. And if you are a veteran investor, this series will be like a refresher course for you. Before we begin, a quick disclaimer. I will be discussing some stocks as examples. I'm not recommending that you buy or sell any of these stocks. In my previous video, I talked about how a private company goes public and begins trading on a stock exchange. In case you missed that video, here's the link. I also talked about why companies need to raise money through an IPO or an initial public offering. Then I talked about how you can make money by investing in the stock market. And finally, I talked about myths associated with investing in the stock market. In this video, I'm going to talk about exchanges, orders, and positions. When a company sells shares directly to an investor, like in an IPO or a seasoned offering, shares are set to trade on a primary market. When you buy shares on a primary market, funds flow from an investor to the company. The company can then use these funds for expansion, to pay off existing debt, to increase the public profile of a company, or liquidate shares of majority shareholders. When investors sell shares they already own to other investors, the shares are set to trade on a secondary market. When you trade on a secondary market, funds flow between investors. Let's say you want to buy some shares of Apple. Now, how are you going to find another investor who already owns shares of Apple? That's when your secondary market comes into play. A stock exchange is an example of a secondary market. Let's say a private company went public. As a public company, it can choose to trade on one or more exchanges. So let's take a look at what an exchange is. A stock exchange is like a marketplace. Think of it as a farmer's market. Vendors go to a farmer's market to sell goods, and buyers go there to buy goods. In case of a stock exchange, these goods are securities such as stocks or options. The farmer's market doesn't own any goods. It only provides an avenue or a platform for buyers and sellers to exchange goods. Similar to that, a stock exchange does not own any securities. It only provides a platform for buyers and sellers of securities to exchange them for a fee. Also, you don't get to know whom you buy your securities from or who you sell your securities to on an exchange. There are about 20 different exchanges in the United States. You may have already heard of the New York Stock Exchange or the NYSE and NASDAQ, and even the more recent Investors Exchange or IEX. There is a very interesting story behind the founding of IEX, and it is documented in the controversial book Flash Boys by Michael Lewis. I have put my affiliate link in the description if you're interested. It's a really interesting read. Exchanges impose certain guidelines on companies that wish to be listed. Guidelines vary by exchange. NYSE, for example, requires companies to have a certain minimum market capitalization, a certain level of pre-tax income, or a minimum number of shareholders. They also have requirements on financial reporting that the companies need to report every quarter. A complete listing of all the guidelines can be found on the exchange's website. I've linked the NYSE guidelines in the description. As long as a company is able to meet these criteria and pay the annual exchange listing fee, which can run in hundreds of thousands of dollars, the company can get listed. Earlier, an exchange used to be a physical location where brokers would meet, and the orders would then get matched across the trading floor. Over time, exchanges have evolved to become these electronic systems that facilitate trades between two investors, each with its own set of trading rules. I'm going to discuss orders in detail in a minute, but here's what an order looks like in brief. Let's say you wish to buy 10,000 shares of Apple for a maximum price of 200 each. That is not what Apple is trading at right now. I just picked a random price. Your order size in this case is 10,000 shares. Back in the day, you would instruct a broker to buy on your behalf. Your broker would then go to the exchange physically and try to match your order. For that, he or she would have to announce your order size and the price you want on the trading floor. Let's say another investor wants to sell 5,000 shares of Apple at $199 and a third investor wants to sell 10,000 shares at a price of $200. Your broker would then purchase 5,000 shares at $199 and another 5,000 shares at $200. That would make your average price equal $199.50. Of course, now this entire process gets done electronically. Every exchange has a real-time listing of all open orders, both buy and sell, and it is available to view for a fee. This listing of open orders is known as an order book. Here's an example of what an order book may look like. On the left, you can see all the buy orders. The orders are in descending order of bid price, which I will explain in a little bit. The first line shows a buy order of 2 shares of Apple at a maximum price of $200 on the New York Stock Exchange. This order was entered at noon. What this means is the order will be executed only if there is a matching sell order with a price at or below $200. The second line shows a buy order of 3 shares at $199.99 on the BATS exchange, and so on. There may be thousands of lines in this order book. This price here is called the bid price, and it is the maximum price a buyer is willing to pay for that order. On the right hand side, you can see all the sell orders. These are in ascending order of ask price. The first line shows a sell order of 9 shares at a minimum price of $200 on the NASDAQ exchange. The second line shows a sell order of 1 share at $200.01 on the IEX exchange. A trade occurs when orders get matched electronically on the exchange. That is when an order's bid price is the same as another order's ask price. And that execution price becomes the last traded price. Institutional investors who pay a fee to view this order book can view the entire order book in real time. Let me show you what this looks like to an individual investor. You can either log into your brokerage account or you can go to Google Finance or Yahoo Finance. This page here, I'm on Yahoo Finance, and in the search bar, I type the ticker of Apple, which is AAPL. You see this price here, 157.28. This is the last traded price at market close on May 6th. You only get to see the top line of the order book on a delayed basis. This line here shows that there is a buy order of 900 shares of Apple at $157.14. and a sell order of 1,200 shares at $157.20. What this tells you is that an investor is willing to buy 900 shares of Apple at or below $157.14, and someone is willing to sell 1,200 shares of Apple at $157.20 or above. When a stock trades often and has a big trading volume, the difference between the ask and bid prices is called the bid-ask spread. Apple is very liquid, so these prices are very close to each other, and the bid-ask spread is small. It is 6 cents in this case. On the other hand, look at a less traded stock like Amylyx Pharmaceuticals. The bid price is $7.68 and the ask price is $8.56, and the bid-ask spread is wider than Apple's. Time for a quick quiz. What do you think will happen if there are more buy orders than sell orders? Pause the video and think about it for a minute and come back. Buy orders indicate demand and sell orders indicate supply. If demand is greater than supply, there is upward pressure on the price, driving the price higher. The reverse happens when the supply is greater than the demand. There is downward pressure on the price, driving it lower. All this is happening in the real time. So you see how orders have the potential of impacting stock prices during the day. You and I as individual investors probably trade fewer than 1,000 shares a day. Institutions, on the other hand, can trade shares worth millions of dollars. If there is a large order, it has the potential to impact stock prices. And institutions want to have a minimal stock impact before their order is complete. Institutions often employ various trading strategies to minimize the impact of their trade on the stock price on an exchange. An exchange is just one example of a secondary market. There are alternative trading venues such as crossing networks and dark pools, which sound very sinister, but actually they can be very useful to institutional investors in reducing the impact on prices while they have ongoing trades. While exchanges have to maintain an order book and display it to investors paying a fee, dark pools have no such requirements. They do not display open orders to other investors. This lack of transparency helps minimize impact on stock prices. All secondary markets, including dark pools, are post-trade transparent, meaning after a trade is executed, these venues have to release trade information. But only exchanges are pre-trade transparent, meaning they have to release information about all open orders on the exchange. Don't worry about these alternative trading venues because as individual investors, our orders are never going to be large enough to require trading on these venues. If you like what you've heard so far, please smash the like button. And if you haven't already, please subscribe to my channel and hit the bell icon so you get access to all my latest videos. Also, if you're watching me on Facebook, don't forget to follow my page. I have also linked my budgeting worksheet and my investment plan template to help you create your own investment plan. Investors cannot trade directly on an exchange. Are you thinking that this Avanti has gone crazy? Didn't she just tell me that you can trade on an exchange? Well, you can trade on an exchange, but you have to go through your broker. A broker is usually a firm rather than a person. Anyone who wants to trade, buy or sell a security will have to go through their own brokerage. A buyer will have his own brokerage and a seller will have his or her own brokerage firm. And these brokerage firms can be the same for a buyer and a seller. Brokers who are members of an exchange can trade on that exchange on behalf of their clients. Historically, brokers would gather on the floor of an exchange physically and negotiate for their clients' trades. Now, most trades occur electronically. There are many different brokerage firms to choose from. Back in the day, I remember paying $4.95 per trade with Options House. Now, the brokerage business has become ultra competitive. There are many different brokerages that charge zero fees. Vanguard, Fidelity, Schwab, TD Ameritrade, Merrill Edge, and so on. Some brokers are more suitable for specific types of products like index funds, and these brokerages can charge fees for trading options or cryptocurrencies. So choose your broker accordingly. When you buy a security, you take a position in that security. Or if you sell out completely of that security, you close your position in that security. Or if you sell partially out of the security, you reduce your position in that security. I'm going to go over some of the positions that you can take in your brokerage account. The first one is a long position. When you buy or hold a security, you are set to have a long position in that security. For example, if I have 10 shares of Apple, I am long Apple, or I have a long position in Apple. And I will benefit if the price of Apple goes up. The potential upside in this case is unlimited because there is no cap or no ceiling on where the price of Apple can go. But the maximum loss or downside is the price at which you bought Apple if the price goes down to zero. The second position is a short position. To take a short position, you sell an asset that you don't own. How do you sell something that you don't own? Well, you borrow it first and then you sell it. You borrow that asset from another investor, you sell it, and then buy that asset again to return it to the lender at a later date. You do all of this electronically and the lender remains anonymous. The brokerage, on the other hand, earns an interest income known as securities lending income by helping one investor borrow from another investor. And they may or may not share that interest income with the lender of that asset. So if you don't receive any securities lending income from your brokerage, you may not even know that securities from your account are being lent to short sellers. The idea here is that you think the price of that stock is going to go down because it is currently overvalued. But since you don't own it, you are able to borrow it from another investor, sell it today, and then hopefully when the price goes down in the future, you can purchase it at a lower price from the market and return it to the lender and make a profit in that process. If I have a short position in Apple, or if I'm short Apple, I will benefit if the price of Apple falls. What do you think is the potential upside in this case? What is the maximum drop Apple can experience? Hypothetically, the price of Apple can go down to zero. It won't, but hypothetically it could, which means that the highest upside or gain that you can get as a short seller is the price at which you shorted Apple at, which is today's price. On the other hand, your downside or potential loss is unlimited because the price of Apple can rise. There is no ceiling on it. Then, if the price of Apple rises, which it can, you will then have to buy Apple at a much higher price to be able to return it to the lender. The risk here is something called as short squeeze. Do you remember the short squeeze of GameStop that was triggered by Reddit users in January of 2021? In case you missed it, here's what happened. During the pandemic, the stock price of GameStop, which is an American video game retailer, had declined. On January 11th of 2021, the stock was trading close to $20. Many hedge funds had short positions in GameStop. The total size of short positions was more than GameStop's market capitalizations back then. Reddit users started bidding the price up of the stock by buying it. When the demand is high and supply is the same, it puts an upward pressure on the price. Investors who were short that stock had to rush to buy the stock, further inflating the already inflated price. By January 27th, the stock had touched 347, a whopping 1600% over just a few days. After the demand normalized, stock was down at about $64 in early February. The short squeeze caused losses worth billions of dollars to hedge funds. Short positions are risky positions even for experienced investors. A third kind of position is a leveraged position. If you have a brokerage account, you may have heard of the term margin. When you fund the purchase of a security partially by borrowing funds from the brokerage, it is known as a leveraged position. The amount that you fund yourself, which is your equity in the brokerage, is known as margin. Leveraged positions can increase your potential gains as well as your losses. I'm going to explain this with an example. Let's say you bought $10,000 of Apple shares in your brokerage on margin. Let's say you used $4,000 of your own funds and borrowed the remaining $6,000 from your broker to fund the purchase. Your equity in this case is $4,000 divided by $10,000, which is 40%, which is the same as your ownership divided by the total value of the asset, which is $10,000. The leverage ratio is the total value of the assets divided by your equity, which is $10,000 divided by $4,000, which is 2.5. Now let's say the price of an Apple share went up by 10%. That would make your Apple shares worth $11,000. Subtracting what you owe the broker, which is $6,000, your portion of the equity is now $5,000. It went up from $4,000 to $5,000. What this means is you put in $4,000, which was your share, and now your share stands at $5,000. So your return in this case is the gain, which is $1,000 divided by $4,000, which is 25%, which is the same as the leverage ratio of 2.5 multiplied by the 10% share increase. Of course, you have to pay interest to your broker for this margin account, but I'm ignoring it for now. Had you funded the entire purchase yourself, your return would have been just 10%. But by taking on this leveraged position, your return was amplified from 10% to 25%. Now let's look at what happens if the share price decreases by 10%. Initially, your Apple position was worth $10,000. With a 10% decrease in price, your position will go down to $9,000. You still owe $6,000 to your broker. So your equity went down from $4,000 to $9,000 minus $6,000, which is $3,000. Your share now stands at $3,000, making your loss equal to $1,000. In percentage terms, this represents minus 1,000 divided by 4,000, which is minus 25%. See how leverage amplified your loss from minus 10% to minus 25%, which is the same as the leverage ratio of 2.5 multiplied by the stock's return of minus 10%. If you add the interest expense that you owe the broker, your loss is even higher. Brokers require a certain minimum amount of margin in your margin brokerage account. When the margin goes below that threshold, it will trigger what is known as a margin call, which is when your broker will call you to fund the shortfall immediately, either by transferring money into your brokerage account or through liquidation of some of the securities that you hold. So let's say you hold only Apple in your margin account, and your broker requires to have at least 25% equity in the account. If the price of Apple falls by more than 20%, your share of equity in your brokerage account will be below 25% and it will trigger a margin call. If you do not fund the shortfall within the time allowed by your brokerage can then force liquidate some of your assets to make up for that shortfall. Short positions and leverage positions can potentially be very risky and are not to be taken lightly. So if you must use them wisely, I personally prefer not to trade on margin. There are a few other things that I wanted to cover today, but I'm going to leave them for my next video. In the next video in this series on the basics of stock market investing, I'm going to discuss orders, execution of orders, and costs associated with your brokerage. Make sure to subscribe to my channel and hit the bell icon so you don't miss the next video. That's it from me this week. As always, don't forget to be happy, to be kind, and to be your best self. Bye. And here are some more videos I think you will enjoy. I would really appreciate your hitting the like button and sharing this video with your friends and family. It will help me reach more people.